Welcome back. You're watching CNBC TV 18 and this is our year-end special series, Rewind 2017.
But now 2017 will mostly be remembered as the year when the government as well as the banking regulator clamped down on the sector's bad loan problem, sending close to 40% of the sector's bad assets to the National Company Law Tribunal. But CNBC TV 18's Ritu Singh reports why 2017 will not just be remembered as the year for bad assets.
For India's banking sector, 2017 has been a transformational year in many ways. The most notable transformation is that the sector finds itself in the midst of the largest bad loan cleanup exercise ever undertaken. Because if 2016 was about digging the skeletons out of the closet, 2017 was about giving them a proper burial, a process that will hopefully give the banking sector some closure as 2018 comes around. In one fell swoop, the Reserve Bank of India took advantage of the recently cleared Insolvency and Bankruptcy Code and marched a quarter of the banking sector's stressed assets to the National Company Law Tribunal. It began with a dirty dozen, 12 accounts identified by the RBI in its first defaulter list. At the time, these 12 accounts together accounted for almost 2.2 lakh crores of the total 8 lakh crore rupees of stressed assets. By the end of the second quarter, the total number has ballooned to over 10 lakh crore rupees, but it was still a strong start.
The IBC puts a time limit of 180 days, extendable by a further 90 days, within which creditors have to agree to a resolution plan, failing which the adjudicating authority under the law will pass a liquidation order on the insolvent company.
But halfway through this 180-day IBC resolution timeline, the government threw these stressed asset account holders for a loop. The rules of the IBC race were changed, and these amendments drastically changed the equation between lenders and errant defaulters, especially when it came to these defaulters regaining control of their companies. So this could well mean promoters like the Ruyas of SR, the Singhals of Bhushan Steel and the Kejriwals of Electrosteel Steels could lose control of their companies for good. The 270-day deadline to resolve these cases before they end up in liquidation ends in April, and bankers are hopeful that a resolution will be found for most, if not all, companies.
If we had taken them to NCLT 1 year ago, the haircut could have been as high as 60-65%. Today, with the revived scenario, maybe the haircut would be 40 or 35%. The debt which they are carrying in their books at that level, even at the current EBITDA margins, it is not sustainable, and write-downs are inevitable.
But even as the industry grappled with the changed resolution process, the RBI identified an additional 28 defaulters, and most of these may also end up in the bankruptcy court. Together, these 40 accounts make up for over 40% of the banking sector's non-performing loans, and a successful resolution of these stressed assets may well signal the end of India's bad loans problem.
2017 was not just about non-performing assets. The year also saw banks regain their feet as the after effects of the government's demonetization drive died down. And it is these very after effects that also dramatically changed the entire landscape of India's digital payment ecosystem.
Even if you see pre-demonetization and now, the usage of cards at POS terminals, the usage of mobile banking as a mode of transactions is all up at least 60% or more in various banks.
RBI data shows that the volume of electronic transactions rose from 671.5 million in November 2016 to 994.3 million by November 2017. Transactions made through the Unified Payment Interface or UPI jumped from a mere 0.3 million in November 2016 to 104.8 million as of November 2017, and mobile transactions surged from 72.3 million in November 2016 to 130 million as of October 2017. Granted, this last number has since slipped to 50.9 million, but as experts say, a revival is possible since the government is not easing up on its digital payments push. In Mumbai, Ritu Singh.
For the real estate sector, however, 2017 was not exactly the dream year that everyone was hoping for. From the introduction of the real estate regulator to the lingering after effects of the government's note ban move and the rise in the number of legal cases against developers by unhappy home buyers. CNBC TV 18's Kevin Lee reports on the many storms that the real estate sector has weathered in 2017.
Now, it was no surprise that demonetization hit the real estate sector especially hard given the large amount of cash in real estate transactions. However, once reports started coming in at the end of the first half of the year, industry watchers, builders and experts were all shocked as to just how bleak things were. The sudden and prolonged drying up of the cash component to property deals shook India's top real estate markets to their foundations. The National Capital Region, for instance, saw a 70% drop in launches between January and June 2017, along with a 25% dip in sales. In Mumbai, new launches were at a 10-year low, with sales down 8%. South India fared marginally better, with Chennai emerging as a bright spot, but given that the city saw heavy flooding in 2016, the base wasn't very high to begin with. Overall, the first half of 2017 was the worst period for sales and new launches for Indian real estate since 2012. Real estate consultancy firm Knight Frank's analysis suggests that it would take over 4 years just to sell existing inventory. But plunging demand wasn't the only roadblock for builders in 2017, nor was it the biggest.
20 years of me being in this industry, it was perhaps the biggest day yesterday with the regulator being formed.
Overall, this new act is a very positive development. I think it is going to be a game changer.
This heralded the implementation of the Real Estate Regulatory Authority, or RERA, and with it, the very landscape of the Indian property market was redrawn. This is a one-stop shop to address homebuyer grievances and punish developers for unscrupulous activities, and it has meant increased compliance for builders and made the straight and narrow straighter and narrower. The new rules say builders have to pay homebuyers in case of project delays. Further, builders will no longer be able to use funds received for one project to build another. But even as developers grappled with the new regulations, home buyers threw them another curveball: legal action. Two landmark real estate cases grabbed the spotlight. The first involved thousands of families who had bought houses being built by JP Infratech, which is facing insolvency proceedings. These homebuyers have since been assured that they will not be excluded from the table when the company's lenders seek to recover their loans. Unitech was the other developer to feel the heat. Even as the Supreme Court heard Unitech's case, the Ministry of Corporate Affairs moved the NCLT seeking permission to supersede the company's board to protect the interest of over 19,000 customers. Now, both these cases are being heard by various courts, but the writing is on the wall. Errant developers are not likely to get away scot-free, and defrauded home buyers have become a big priority. So as far as the real estate sector is concerned, 2017 will go down as the year of the home buyer. In Mumbai, Kevin Lee.
The government's demonetization move may have been a massive disruptor for the Indian economy, but not so much for the mutual fund sector. CNBC TV 18's Yash Jain reports how the sustained rush of liquidity in the system through 2017 has translated into unprecedented flows for the mutual fund industry.
Last year, this figure of 3.43 lakh crore, which came to the mutual fund mobilization, additional mobilization, is a record. And I think more and more money coming to the formal sector post demonetization definitely will give it a further boost.
The SEBI chief's predictions came true, and how? A surge of deposits due to demonetization resulted in falling deposit rates. And as people looked for other places to invest their money, a supportive equity market and positive macroeconomic indicators led them to mutual funds. Because as the advertisement says,
Mutual funds, sahi hai.
So as 2017 began coming to a close, data showed that mutual fund houses have taken in over 5 lakh crore rupees of retail investor wealth over the year. That's a 50% growth over 2016 inflows. And full year data is not available just yet. It wasn't just lump sum investments. Systematic investment plans saw unprecedented demand, suggesting that investors were looking at mutual fund schemes not as just a temporary parking lot for excess cash, but as a long-term play.
And SIP book size reaching a new height every month is a true reflection and a testimony of the industry's effort in building a retail long-term sustainable business model.
The shift in the investment ideology may prove beneficial for the mutual fund industry through 2018 as well, especially if market regulator SEBI delivers a late Christmas gift by allowing mutual funds to invest in commodity derivatives, a move which will substantially widen the investment net by including commodity traders. In Mumbai, Yash Jain.
So Priya, that in a nutshell was what 2017 was all about. But with that, it's an end to this special edition Rewind 2017. From all of us here at CNBC TV 18, many thanks for watching.
And wishing all of you a very happy and prosperous New Year.